Welcome back to Being Financially. ETFs, you're not alone, both are popular. But which one actually makes you more money and fits your investing goals better? In this video, I'll break it down side by side and help you decide which is better for you. Stay tuned. So you've decided to invest in the stock market, but are unsure whether mutual funds or ETFs are the right choice for you. Both options have their own set of advantages and disadvantages. So it's important to carefully consider your investment goals and risk tolerance before making a decision. Mutual funds are actively managed by professional fund managers who select a diversified portfolio of stocks, bonds, or other securities. They are a great option for passive investors who are looking for a hands-off approach to investing. Additionally, mutual funds often offer the benefit of automatic reinvestment of dividends and capital gains, allowing for compounded growth over time. On the other hand, ETFs, exchange-traded funds, are passively managed and aim to replicate the performance of a particular index, sector, or commodity. They are traded on an exchange, just like stocks, and offer the benefit of intraday trading and lower expense ratios compared to mutual funds. When it comes to making money, both mutual funds and ETFs have the potential for significant returns, but it ultimately depends on the performance of the underlying securities. While mutual funds may provide the opportunity for higher returns through active management, ETFs offer lower expense ratios and the potential for tax efficiency. When considering your investing goals, it's important to assess whether you prefer a hands-off approach with a mutual fund or the flexibility of intraday trading with an ETF. Additionally, consider your risk tolerance and the level of diversification you are looking for in your portfolio. In the decision between mutual funds and ETFs ultimately comes down to your specific investing goals and preferences. Both options have their own set of pros and cons, so it's important to carefully evaluate your options before making a decision. By doing so, you can ensure that you're making the best choice for your financial future. Stay tuned as we delve deeper into the specifics of mutual funds and ETFs. Have you ever wondered about the difference between mutual funds and ETFs? Mutual funds are pooled investments that can be actively or passively managed. This means that a team of managers makes decisions about which assets to buy and sell on behalf of the investors in the fund. On the other hand, ETFs are traded like stocks and are generally passively managed, tracking a specific index. This means that they aim to replicate the performance of the index they are based on. When it comes to buying and selling these investments, mutual funds are typically bought or sold at the end of the trading day based on the net asset value (NAV) of the fund. This means that investors may not know the exact price they will be buying or selling at until after the market has closed. ETFs, on the other hand, are bought and sold throughout the trading day at market prices. This allows investors to know the exact price they are paying or receiving when trading ETFs. In summary, mutual funds are pooled investments that can be actively or passively managed, while ETFs are traded like stocks and are generally passively managed. The main difference in how they are bought and sold lies in the timing and pricing of transactions. So whether you prefer the active management of mutual funds or the convenience of trading ETFs like stocks, there are options available for every type of investor. When considering where to invest your hard-earned money, it's crucial to look at the key comparison factors between mutual funds and ETFs. Let's break down each factor to help you make an informed decision. First, let's talk about fees and expenses. Mutual funds often come with higher management fees eating into your potential returns. For example, a typical mutual fund may have a management fee of around 1.5%. On the other hand, ETFs generally have lower expense ratios, usually around 0.5%. This difference may seem small, but over time it can significantly impact your investment growth. Next up is liquidity and trading. ETFs trade like stocks, meaning you can buy and sell them in real time throughout the trading day. In contrast, mutual funds only trade once, daily after the market closes. This difference in trading flexibility can be crucial, especially in volatile market conditions. When it comes to minimum investment requirements, mutual funds often have a higher entry barrier. You may need a few $1,000s to invest in a mutual fund initially. In contrast, ETFs can be bought per share, allowing you to start investing with a lower amount of money, making them more accessible to beginner investors. Tax efficiency is another important factor to consider. ETFs are known for being more tax efficient due to their ability to redeem shares in kind, minimizing capital gains taxes. On the other hand, mutual funds can trigger capital gains more frequently, potentially increasing your tax liabilities. Lastly, let's touch on management style. Mutual funds can be actively managed, meaning a professional fund manager makes investment decisions to try and outperform the market. In comparison, ETFs are usually passively managed, tracking a specific index's performance. However, active ETFs also exist now, offering a middle ground between active and passive management. In conclusion, both mutual funds and ETFs have their pros and cons. Consider these key comparison factors carefully to decide which investment option aligns best with your financial goals and risk tolerance. Remember, investing is a long-term game, so choose wisely and stay informed. When it comes to investing, there are a variety of options to consider. One of the key decisions to make is whether to invest in mutual funds or exchange-traded funds, ETFs. Both have their advantages and drawbacks, so which one is better? It depends on your specific needs and preferences. For those planning for retirement through a 401k or systematic investment plan, SIP, mutual funds are commonly used. Mutual funds provide a simple and easy way to diversify your investment portfolio without the need for constant monitoring or trading. This makes them a popular choice for long-term retirement planning, as they offer a hands-off approach to investing. On the other hand, if you are interested in trading or holding short-term positions, ETFs may be the better option for you. ETFs trade on an exchange just like a stock, providing flexibility for investors who want to buy and sell throughout the day. This makes them a useful tool for those looking to capitalize on short-term market movements and trends. When it comes to low-fee long-term investing, ETFs tend to shine. ETFs typically have lower expense ratios compared to mutual funds, making them an attractive option for cost-conscious investors. Additionally, their ability to be bought and sold throughout the day at market price provides flexibility for long-term investors to make strategic moves when necessary. For those who prefer professional fund management and are willing to pay for it, mutual funds may be the better choice. Mutual funds are actively managed by professional fund managers who make investment decisions on behalf of the fund's investors. This hands-on approach can be appealing to those who want the expertise and guidance of seasoned professionals. In conclusion, the choice between mutual funds and ETFs depends on your individual investment goals and preferences. If simplicity and long-term retirement planning are your main focus, mutual funds might be the way to go. However, if you are cost-conscious, want flexibility, and are more interested in trading or short-term positions, then ETFs may be the better fit for you. Ultimately, it's important to carefully consider your investment objectives and do your research before making a decision. At the end of the day, both active and passive investing are powerful tools, but it all comes down to your goals, fees, and how hands-on you want to be. So, which one are you going with? Drop your answer in the comments. And don't forget to like, subscribe, and check out my investing playlist, linked right here. When it comes to investing, there are two main strategies, active and passive. Active investing involves a hands-on approach where investors aim to outperform the market by buying and selling securities based on research, market trends, and other factors. On the other hand, passive investing involves a more hands-off approach, where investors aim to match the returns of a specific market index by holding a diversified portfolio of securities. If your goal is to potentially earn higher returns by actively managing your portfolio and staying on top of market trends, then active investing might be the right choice for you. However, it's important to consider the fees associated with active investing, as they can often be higher due to the increased trading and research involved. On the other hand, if you prefer a more passive and low-cost approach to investing, then passive investing might be the better option. With passive investing, you can benefit from lower fees and a more predictable investment strategy, as you're simply aiming to match the returns of the overall market. Ultimately, the choice between active and passive investing comes down to your personal goals, comfort level with risk, and how hands-on you want to be with your investments. Both strategies have their own advantages and drawbacks, so it's important to carefully consider which one aligns best with your financial goals and preferences. So, which one are you going with? Drop your answer in the comments below. And if you found this information helpful, don't forget to like, subscribe, and check out my investing playlist. Linked right here. Thank you for watching.